Hello, I'm Greg Pennell. Welcome to TD Active Trader Live, brought to you by TD Direct Investing. This is your educational one-stop shop for in-depth market analysis and investment insights that boost your trading potential. Coming up, U.S. markets navigating the conflict in the Middle East. We have higher oil prices, investors weighing that geopolitical risk alongside inflation risk, and of course, upcoming economic data. We're going to dig through all that. Plus, our trader debaters are here. They're getting ready to take on the bull and bear cases for Oracle. It's cloud and AI momentum versus capital spending pressures and valuation risk, all ahead of earnings. We're also going to show you actionable option strategies to play both sides. And if that's not enough, we got your full earnings preview for Costco before its results hit the tape on Thursday. That is all ahead. Don't forget to like and subscribe. You're watching TD Active Trader Live. Into the trading day, let's check in on the S&P 500. The market largely shrugging off the conflict in the Middle East yesterday, but as it intensifies, you can see the market is no longer ignoring this one. A sharp pullback for the S&P 500, for the Dow, for the Nasdaq. If you're watching the TSX here at home, it is even deeper in the red. Want to jump into the heat map and see what we have on our hands right now. We're not going to find a lot of green on the screen. You got Costco standing out, a few retailers, but for the most part, we got widespread selling. The financial services stocks are down, the tech stocks are down. Pretty much everything's down right now. Let's get to our stock of the hour, Oracle. Got a one-year chart to look at here. Of course, we climbed that mountain and came back down the other side. So much AI excitement. What's the business here? Database software, cloud computing, squarely in the AI trade. But now the market's looking for winners and losers. It is an expensive place to play. I think it's time to bring in our trader debaters. Head over to the desk, Jason Nanick and Here Amin from our direct investing education team to give us the bull and bear case for all of this. We also have a special guest studio audience. We love it because it keeps us on our toes. We have our direct investing interns with us. Thanks for being here on the show. This is your chance to make some noise before you got to be quiet. So yeah, let's make some noise. And now we just let the guys take it over. Before we get going with the debate, which is the heart of the show, just a reminder to our viewers that the securities and strategies discussed on our show are for educational purposes only, should not be considered investment advice or buy, sell, or hold recommendations. Options trading carries high risk, may not suit all investors. Significant losses are possible, so it's important to assess your own risk tolerance. Make sure you do your own due diligence before engaging in trading. Now back to the stock of the hour, Oracle. We're going to get some time on the clock. We'll keep you honest with the bell. 2.5 minutes to make your cases. As always, we draw out of the hat. We flip the coin. You've taken me out of the process because I just complicated it. Whatever we did, we ended up with Jason as the bull. Why don't you take it away?
I am the bull this week, so this is good to go. All right, let's get into it. So Oracle is it's unique too. It's kind of full stack. It's got everything kind of under one umbrella. Integration, physical data centers. We're talking high performance networking, database layers, enterprise level applications. So the list goes on here. But one of the most impressive things to me when doing some research is how Oracle has kind of positioned itself as kind of a neutral partner when we're thinking about AI and we're thinking about clouds. And most notably, this is kind of really exemplified by the Oracle multi-cloud strategic approach. There's some really impressive numbers here. One of the key developments here is that they're kind of working with some of the biggest of the big players when we're talking AI, Azure, AWS, Google Cloud, and they run Oracle databases within their own sites and also give them access to bigger public clouds and creating domains within that. This offers them lower cost, flexibility, and even really what's important, that low latency that's weird. And this has also led to some really big results that Oracle certainly not shy about talking about. We're talking growth in the multi-cloud database. It's really hard to overstate. We're talking over 800% growth from the last quarter alone. And if we take a step back and looking at the bigger cloud infrastructure, 4 of the 5 last quarters, we've seen, listen for it, 50% growth in that sector. So we're talking big numbers here. All right, and oftentimes, you mentioned it off the top, people talk about big capital investments, but Oracle's continued to deliver solid profitability, earnings alongside strategic growth investments. We're talking trailing 12-month revenues up considerably, showing sustained growth, $61 billion versus $55 billion the previous year. Margins are strengthening. We're in the 20s, now in the 30s. The one that really jumped out to me was gross profit margins. We're talking 66%. That's in the top 10% of companies in that sector. But let's get ourselves in the chart so we can talk about this. Oracle itself, coming off highs that certainly certainly unquestionable that's happening here. Oftentimes, companies aren't moving down based on their strength. There's other pressures in the markets, valuations and things like that. But what I did notice here is when we've come down, we've found and found support around $140. We've tested it multiple times over the near-term period. We actually have a triangle pattern that's forming on the chart. With those supports that's developing, that support's showing that we do have potential to break out the upside. One of the things that's also showing me there might be some positive signs for a turnaround. We do have a mild divergence from the MACD perspective. We're seeing a bearish trend on the chart coming down towards 140, but MACD is trending upwards. And if we look over shorter periods of time, looking towards the kind of a more 60-day time frame, I've got a 4-hour candle here. MACD is also trending upwards with that cross supporting the double bottom.
I liked halfway through your argument how you looked at here and you said, "Listen for it."
Then
you dropped a big number on him. What do you got?
All right, let's talk about some of those big numbers. Oracle has $523 billion backlog, and yet the stock is down. Wait for it. 58% from its high, from 345. It's down 58%. Let that sink in. This is a company that announced the largest AI infrastructure deal in history. And how did the market react? By selling it relentlessly. Maybe the market knows something. So let's talk about some of the knowns. The free cash flow is negative first at $13.2 billion. It's not shrinking. It's not pressured. It is negative. Oracle is burning cash at a scale that would make a startup blush. And to plug that hole, they issued $25 billion in new debt on top of the $108 billion in debt they already have on the balance sheet and the $1 billion in quarterly interest payments that they make. The debt to equity ratio right now sits at 4.3%. That, or 4.3x, I should say, multiple. That's a 400x. So for every dollar of equity they own, they have $4 in debt, essentially. Some analysts are even, warning of elevated credit risk pressures, higher funding costs as credit default swap spreads widen. So this is basically bondholders who are trying to hedge their risk. They go out to get credit default swaps, and this is the widest spread that they've had since the 2008 financial crisis. Let's talk about the CapEx. This is, they're spending like a drunken sailor on data centers and GPUs, but the cash isn't showing up. Oracle guided $50 billion in annual CapEx, up from $6 billion just 2 years ago. For context, the entire trailing 12-month revenue is at $61 billion. They're spending nearly as much building data centers as they earn from selling softwares. And one way they're funding this is by diluting shareholders. They just issued $20 billion in new stock issuance. That's roughly 5% of dilution for the stockholders. So invest, and then on top of this, now investors are actually suing Oracle over this because they misled investors on AI growth hype, falsely assuring investors that the company's significant CapEx would quickly result in accelerated revenue growth, which is not happening. And then finally, I just wanted to mention, when you think about the $52 billion they're talking about, the near-term visibility on a company that's priced at a 535 enterprise value with negative free cash flow and a securities class action lawsuit, the rest of that backlog is just a promissory note spread across like years and in margins we don't even know yet. Let's actually jump into the charts. I've got very little time. So I wanted to just show two major things. One is the head and shoulders pattern that's forming in the longer term. That's a bearish reversal sign. You also see this very big bearish channel that's breaking down. And the key moment is right over here, the cross below the long-term trend over here.
Leaving so little time at the end for the chart, I thought your strategy was just going to be to throw the chart up and say, what more can I say?
That's good enough as well. Yeah.
So, yeah.
All right, you've clearly staked your claims. How much a little time to counter back and forth? This is where the guys just get to go at it, unfree, unfettered.
Let's
I'll let Jay have the first word.
Let's have at it. So I do want to just mention something. Even with all this spending on data centers, there's still the positive cash flow. Talking like $10.2 billion. So there's still money coming in the door above and beyond what we're spending here. But that big thing around those data centers and going to get us that bang for the buck, they're the largest provider. They have the most data centers worldwide with 147, with 64 more in development that are looking as of December 22. So these are the infrastructure that allow big businesses to continue to spend the dollars, looking to pay for power of computing, storage, infrastructure, leasing those GPUs. And if we come back to those RPOs, those record backlogs in terms of their contracts, we're talking, this isn't chump change. This is actually allows us to see in the pipeline from an investor perspective to see what's sales we've got that will be hitting the balance sheet in the future. So it's really a nice thing. And this is partly playing into the fact when we think about fair market value, well, Morningstar's got fair market value, north of $235, so well above where we're at. So there's obviously room to grow, and we were there just very recently. So many investors might be seeing the stock as being on sale right now.
Let's actually talk about that $523 billion backlog you talked about, which apparently is massive demand. $300 billion of that backlog is from just one single customer, and that is OpenAI. And as we know, if you have 57% of that backlog pinned on one, and OpenAI's future is as stable as a Jenga tower on an earthquake, is what it is. That backlog isn't cash in the bank. It's a promise, a hope, and a maybe at best. So investors are basically pricing in the future revenue that's so far out that it's practically in another time zone, maybe even call it another postal code. So you can't rely on that, especially when they're only expecting in this year alone, the next 12 months, to only realize less than 10% of that backlog that they have. The other thing on the data center, Jay, that's interesting you mentioned is you've seen hyperscalers go the other way compared to what Oracle's doing. Oracle's laying all this money down and they're pulling it out of their own pockets to build these data centers, where you have hyperscalers like Microsoft who's decided we don't know what the demand's going to be like. Let's go and do the renting model right now. You do the renting when you're not really sure if you actually want permanence in this space. And Oracle's going the other way, and this is companies that actually generate much greater free cash flow than Oracle does.
You know what is still growing and still robust and accelerating is still that revenue that's coming in year over year from those cloud dollars, right? So it's 34% year over year from their cloud infrastructure. We're talking 66% on those rentals from the GPU perspective. So this is not nothing. We've got actual dollars coming into play. And when you brought up OpenAI, there's a pretty substantial contract with them, $300 billion for a partnership on some we're talking, bigger, huge supercomputers. Oracle's just released its largest.
It's a promissory note. When? Like, I can tell you I'm going to invest $300 with you, but who knows? Doesn't mean anything until the cash comes in.
But it's also what the market's pricing it is. They're looking at future value.
Can we pull the charts up? It's already priced in what they're expecting, right? Like, there's already saw that from.
How about I tug on your heartstrings? How about I tug on your heartstrings to end it all? What's your favorite sport that you like to watch on TV? F1. Oracle's got a big partnership with Red Bull, and that's been confirmed going forward. So.
That was vicious. They haven't been this vicious in a while. I think this was for the benefit of our live studio audience. Okay, we got some time now to cool off. Take us into the charts. Show us some possible options, strategies around your positions. Jay, why don't you take it away?
Yeah, let's talk that. Let me calm down here. I feel like that was quite the boxing match for sure. So when we're thinking about an option strategy here, is oftentimes we're thinking about how we can play the directionality of the market, but it is also about how we can maybe remove a little bit of risk from in terms of versus a stock position that we could make. So with this position that we're thinking about is called a synthetic long stock position. So it's taking the risk and reward profile of buying the stock, but doing that with options. So we know that with options, there's going to be a time-based element to this. We're limiting the time that we've got to be right, but we've got the opportunity to participate in potential upsides and buying a stock that could be on sale with a much smaller investment up front. So let's bring us in the chart. Usually we've kind of done this where we've kind of had a fancy chart and talked you through some profit and loss. I wanted to kind of take a bit of a different approach and do that through the option chain and the risk profile in the platform. So a potential example of a synthetic long position would be to buy a long call. We're going to buy out into August. So we've got almost 6 months worth of, actually almost 6 months. Let's get that right. Almost 6 months worth of time. So we're going to go ahead and buy the long call at 150, and we're also going to sell at the exact same time to offset the cost, but to also give us the additional bullish exposure. We're going to sell the 150 put at the same time. So I'm going to go ahead and click on the little plus button next to the ask or next to the bid price on the put. That's going to bring my position. This platform is actually really helpful. It gives the name of the strategy right in the order ticket, so that's there for us to see. The next thing I want to show for everybody is to take a look at the risk profile within the platform. I'm going to toggle on the analyze button in the top right of my ticket. It now says analyze where my confirm and send button was. Now that I've done that, I'm creating that plan position, jumping over to my analyze tab. I've got my risk profile now here. This is exactly what you would see if you had a long stock position. Every dollar it goes up, you're making a dollar. Every dollar it goes down, you're losing a dollar. So we've got that demonstration that in fact is here. But instead of having to spend, if we go back and grab the quote here, $145 a share, we're only spending, if we look at the cost to the trade, we're at this point, it's actually bringing us in a credit of $2.50. So we're able to get that exposure with, typically that's going to be for a small debit, so less money. So less money than the stock would be to purchase, but then also taking on that same risk profile if the stock does go down.
So the bull, if it doesn't work out, what do we need to keep in mind during a trade like
in this particular case, right, you've got time, so we don't have as much exposure to time and volatility, but we do have dollar for dollar exposure if the stock goes down. So this is the same exact, if the stock goes to zero is worst case scenario. So if it's 145 now, we're risking $145 per share per contract.
All right, interesting trade there. How about a possible side for the bear?
Yeah, one way you could look at doing the bearish trade, Greg, is we want to look at the downside movement potentially. So I'm just going to bring the charts up, and I just wanted to go back to where we're looking at key support areas where we feel there's still some pressure on hand. So you can see the 127 is a key area. It was one that was breached back in early 2025 around that the tariff liberation day. So we could potentially coming into the earnings print, we could see that get tested. So one strategy to do this, if you want to play directionality, is to do what's called a long put condor trade. So I'm just going to expand this for a second, and I'll walk you through the reasoning on why we want to do this trade. One, it is directionality. So if you are of the belief that we feel that there's still going to be downward pressure on the stock, we want to be able to do that, but also, I have to remember that the stock is its implied volatility, which is the expected moves that's going to happen, is in the 93rd percentile, which means the options are going to reflect that by being a little bit more expensive than what they usually would be. So what a long put condor essentially is, it comprises of a debit spread and a credit spread. So the debit spread essentially is we're looking to buy just out of the money right now, buy the 140 put. We're going to sell the 130. Now I'm expecting it still to go even further down, but I want to just capture that. So that's where we're selling the 130. We're giving ourselves some breathing room between that, and then selling a credit spread at the 120 put, and then buying the 110. Now this extra selling makes the overall cost lower for us. And that's what actually gives us the net debit. So you can see the net debit cost is about just roughly $2. If I just bring up the order entry ticket, you can see it queued up even with the move down. It's costing us a mid. I've just got it priced at $2. So break-even price here is we need Oracle to come down essentially. We need it to break to 138. You can see I've got my break-even price here. And anything below the 138 is starting to be a profit for us there, until it gets to the 130 level there.
All right, let's say your trade doesn't meet our needs. I know you got to reveal for me.
I got to reveal. All right, let's roll it up.
Drum roll, please.
Okay, so in this kind of trade, of course, it's always going to be the debit that you spent. In this case, it's the $2, or in a single contract, $200. That's it. So, and there's two ways this could happen. One is if the stock stays above 140, we lose out on that. It didn't go in our direction. But it also hurts us if it goes too much in our direction. And that means if it falls into this 120 zone, falls right down below 110, then it's like a scratch on the trade. We made 10 on the way down, and then we lost 10 on the way below 110. So we're still out the initial debit. So it's just $2 on this trade, risk defined.
All right, interesting possible strategies there for our audience to chew on. Thanks for laying out the bull and bear cases so vigorously today for Oracle. Just a reminder to our viewers that this debate was for educational purposes and does not reflect our personal opinions about the stock. Before we move on, Jay, you were talking about the MACD indicator.
Yeah, we're going to talk MACD here today, kind of continuing that discussion. We talked money flow last week, move into MACD this week. So this is a trend following kind of momentum indicator. Helps us understand trend direction, trend strength, maybe even looking for potential signs of trend reversals as well. So it does this by taking a shorter average, which is typically a 12 EMA or exponential moving average, and then combining that with a 26 period moving average, or exponential moving average. Let's jump into the chart and get a look. So if we just take a look at the study itself, which is below my chart here at the bottom of my screen, there's a lot going on, but let's explain it here. You've got this blue line. This is what we call the MACD line. This is the difference between the 12 and the 26. So we're judging how prices are, if they're increasing or decreasing versus short-term versus long-term periods. That's that blue line, the MACD line. This yellow line, that's what we call the signal line. The signal line is in essence just an average of the MACD line. So that creates opportunities to look for crosses on this. When we're thinking about kind of trading signals, we're looking to see if the MACD line is crossing above or below the signal line. If it's crossing above, that could be your bullish indication. And then additionally, what you're seeing, this is also sometimes a little bit confusing for people. These little bars that we see in the back of the study, that's what we call the histogram. That is in fact the distance between the MACD line and the signal line. When you have the MACD line above the signal line, as we do now, you'll see green bars. And as it increases, which we're looking for, decreasing that distance from the signal line, the bars will get taller as well. Additionally, another signal that we're looking for is when the MACD line crosses above or below zero. That could be indication of trend strength and trend reversal. Last thing, it says it right in the name, that divergence element. If I just kind of quickly draw a line on the chart, we can see that the stock in question, Oracle, we've got a downward trending slope. The MACD line happens to be trending in the opposite direction, so it's diverging in the direction that it's trending in. That could be a sign that is a forward-looking indicator that we could be due for a trend reversal.
Okay, interesting stuff. Thanks for that, Jason. If you at home have a question about the TD Active Trader platform, or if there's a stock you want to see our debaters go head-to-head on, send us an email at td.activetraderlive@td.com. And for more information about the Active Trader platform, scan that QR code on the bottom right-hand side of your screen. It's going to take you to our TD Active Trader Live website, where you can try out the platform risk-free by opening a practice account, clicking on that Try TD Active Trader button. Then when you're ready to switch to a live account, simply export your workspace and start trading for real. Time now to find out what is on the radar of the panel for the rest of the trading week. What are you taking a look at here?
Yeah, Greg, if you asked me, if we're going to have a calm start to March, it probably wasn't on anyone's bingo cards, of course.
No.
So geopolitics aside, of course, investors will be preparing for a raft of potentially crucial economic data that's going to come out this week. But the big parade is going to be on Friday. We've got the February NFP report on non-farm payrolls. In other words, simply it's the jobs report that's coming out. So investors, obviously coming into this week, Friday was a big day because they were startled by Block, Jack Dorsey's company, the payment processor,
saying,
announcing
AI means we can chop, like almost half of our stuff.
Yeah, they chopped, heads are going to roll 50 to the tune of 50%. So that's really intensified the drama around AI and what, that could lead to mass layoffs as companies are really, citing the technology not only as a means to cut costs, but also increase its productivity. So this Friday's job employment will be a key catalyst for the stock market. The expectation is actually coming in at a midpoint of 65,000 jobs created. This is going to be down from 130,000 back in January. So the unemployment rate's expected to hold at 4.3%. So any cracks in the labor market widening, it could lead to a slowdown in consumer spending, and that would prompt investors to really reconsider the whether high valuations in the stock market are justified. And then we've got retail sales as well. So this is just another checkpoint. Retail sales are just an honest shocker.
Right?
Exactly. We've got, last month it missed by 0.5 percentage points, despite, non-farm payrolls coming in pretty strong. So the consensus this time around, and this is going to be for January's, in fact, retail sales, they're again expected to come down 0.5% month over month, with significantly weaker motor vehicle sales weighing on the headline growth. The other thing that's also weighing on this is consumer loan delinquencies in Q4 suggest that U.S. consumers, specifically the lower and middle class, are increasingly stretched with less room for discretionary spending. And then the other thing that's the oddity this week, despite everything that's happening, is President Trump will be hosting, leading data center and AI companies this Wednesday at Washington, the White House. It's really to chat about, so Microsoft, Amazon, Meta, all those big wigs are going to be there to formalize a deal to protect customers from the increasing power costs. This is really keeping an eye to the midterm elections that are coming. And then finally, we're looking at Adobe. Adobe's had earnings coming next week, Thursday. So, of course, we know Adobe, they're leading digital media company with creative tools.
But survive the AI scare, right?
Yeah, exactly.
AI
that's
is
the big
helper
question.
or Hector, right?
It's the AI existentialism. That's the market's fear that, the Gen AI will be taking, especially in a business like Adobe, who provides its cloud services, which anyone can do on like Instagram these days. So with their earnings, the expectation is, 485 EPS, which is a 13% year-over growth, 6.2 billion, 10% year-over growth on the top line there. Expectation on the margin is roughly 45 to 46% on operating margin. So the market will really look for evidence on the net revenue, annualized recurring revenue. That's a key sort of subscription measure that they look at. Turning those AI features where they tout it as freemiums to start with, and then converting that into sort of enterprise credits where people are now paying for it. So that'll be a big thing. And then the other news that had the stock drop was the Canva. Canva, its closest rival, had a recent acquisition of two companies, which are now going to look at, really starting to eat a little bit of Adobe's lunch over there. So this report will be a show me quarter for CEO Shantanu Narayan. If Adobe can demonstrate that AI monetization is scaling without compromising the 45% margins, that narrative could quickly shift from AI victim to AI victor. And the charts are saying completely different, so we'll see. They definitely need a lifeline. You can see they've had a dramatic fall since like 2024, just going one way. There's a couple of bearish sort of patterns that have formed, the inverse cup and handle. I don't typically do this. I always get the cup and handle, but we got the inverse one, which is a move down, and it's about in the forming a bearish flag pattern as well that we see over here. It is finding a little bit of support at this 255 level, but it's certainly fallen from grace. When it hit highs close to $700, we're sitting at 255. And each earnings in the previous, I would say, over the last time, we've had 3 major earnings with major gap downs. So if this one disappoints, we could see it break below these COVID lows of 255 and maybe go down and test 210. On the top side, if it really wows the street, maybe we could push back closer to the 300 level.
Right, Adobe is one to watch. And Jay, whether Adobe or AI can better airbrush my face, at some point I'm still going to need my giant jar of pickles.
You are going to need your pickles or your $1.50 hot dogs, whatever floats your boat, right? So we're doing Costco. They report March 5th after the bell, so this coming Thursday. We have talked Costco here on the program before, and I distinctly remember getting battered by you, so thank you for that. On that. But this is a stock that's spun on a bull run of all bull runs. Just taking a snapshot over the last 10 years, Costco is up, nearly 600%. So that's quite the performance. But 2025 was the exception to that rule, marking only just the second time since the global financial crisis back in 2008 that the stock depreciated over a full calendar year. They shed about 16% in price, so that's not nothing here. Share price has actually taken a bit of a favorable turn in 2026, but the old investing adage, we've talked about it on the upside, but this also works on the downside. A falling tide, sinks all ships, right? We can go that way. Global, obviously, uncertainties abound, investor confidence. So no shade on Costco, but there might be larger factors at play that might get in the way of the run that we've got. But shifting to earnings, what we can listen for and what we can look for. On the top line of things, we're talking 451 earnings per share. It's about $69 billion in terms of revenue. Those are both sizable increases, 13 and 8.6%. But the one that everybody looks for when we're thinking retail, right, comparable same-store sales, that they're looking forward to growth there of around 6.5%. So that's a big number. I want to be listening for digital sales. Sometimes Costco's not really participated. They've actively tried to get out of that market. It felt, but they actually seen big increases last time, around 20%. So we'll see what their outlook and if what growth story continues. And then lastly here, we know they're a business and you need a membership to get yourselves in. It's renewals we want to be hearing from them. We actually saw upticks in revenue in Q1 about 14% thanks to fee increases we saw in previous years, but that was kind of offset by lowering renewal rates. Might sound high, over 92%, but if it's a downward trend, then that's something we want to be keeping an eye on for future quarters over quarters. But let's get ourselves into the chart so we can see the stock has bounced off lows we had kind of mid-December. With rises of this kind of magnitude, you're expecting to see the crosses that we always talk about, your golden crosses, the price crosses, things like that. They've been evident. The stock has kind of bounced itself off a number of times off that $1,000. That's that kind of mental barrier that it's seeing here, something that's been significant in the past. With the bull run that we've been seeing, there's been a head and shoulders pattern that's kind of developed here. It's not been confirmed yet. We've not broken below the neckline on the right-hand shoulder. So as we head into earnings, if we can get bounce off that $1,000 support, continue on that upward run, we could be heading towards those highs that had demonstrated some kind of midsummer around, trending towards 1,100. Additionally, if it do confirm, we're looking at around 940 if the head and shoulders measured move is kind of in play.
All right, interesting one to watch. And every time I hear about Costco, I think, and perhaps our studio audience will be able to. So my sons are about the same age as you guys. Last year, they couldn't wait till noon for their lunch break to go for the $1.50 hot dog, and they got nabbed in the parking lot at 11:45, taking an early lunch break. We are right on top of a food court, so good luck with those temptations, guys. Try not to get caught when you're going downstairs in the elevator, at least not by your boss. I won't say anything. I'll just keep that nod and look the other way. All right, guys, thanks for that. Before we go for the show, something every viewer should keep in mind this time of year. Ahead of tax season, you got to be alert for bank impersonation scams. Emails and texts may ask you to verify information or complete forms like a W-8 Ben. Red flags include urgency, threats, or unfamiliar sender addresses. TD will never email or text you a link to log in or submit tax documents. If you receive a suspicious message, do not click on it. Forward emails or send screenshots of the text to phishing@td.com. Now that is our show for this Tuesday. We are back on Thursday. Our guest is Liz Miller from Summit Place Financial. We'd like to thank the direct investing interns for being in studio today. Too early to go on lunch break, guys. At least hold it till 11:45. And at home, as always, investors should perform their own due diligence before engaging in trading. Thanks for watching.